Good morning, everyone, and let's get straight to it. Don't make the same mistake as the US banking system. Because right now, across America, small and regional sized banks, depositors in those banks, investors in those banks are making one huge, massive error. They are all praying that they will keep enough deposits until the Federal Reserve starts cutting interest rates aggressively again. It's not going to happen, which is going to bring an incredible breaking point to bear on the US banking system before the end of this year. What's more likely to happen is that the Federal Reserve at best will simply stay on hold through the rest of this year. The reason being, core inflation remains stubbornly high. If the banking system in the US is forced to revalue their bond assets to market, price to market, they are in big trouble. Not hundreds of banks across America, but perhaps thousands of banks across America could go out of business by the end of this year. That's a major crisis. And everyone wants to look the other way because it's too painful to think about. But I suggest to you what would happen to the US property market. Well, obviously the US economy, but let's talk assets. US property market, US stock market, US bond market, and the US dollar. Be very aware that right now, the interest rate setting of the Federal Reserve is still at a stimulatory level historically. One might be able, at best, to make the case that US interest rates are currently at the new neutral, the new normal. I think that new normal could still be higher if the core inflation data remains as persistent as it has been. If you look back over the last few months of core inflation, it's remaining around the 0.4, 0.5% mark on a monthly basis, and the annual basis is really looking like it could be stubbornly high in the 4.8 to 5.5% range over coming months. If it stays merely above 4.5%, and let me be clear about this, if the core inflation rate continues to run, let's say at 0.4% a month, 0.3% a month even, over the next 2 to 3 months, the Federal Reserve's very next interest rate move will be to hike interest rates again. And it is unlikely that if core inflation is that persistent, that just another 20, at this current level of 5.25, it's very unlikely that a simple little nudge to 5.5% will be enough to undo such stubborn core inflation, which means we're more likely looking at further Fed hikes of 25 to 75 points, taking the Fed funds rate to 6% or higher over the next 6 to 9 months. Such a shock to the current market group think, such a shock to current market sentiment would be almost catastrophic for equities, property, bond, and the US dollar. And we haven't even gotten to the potential for a US debt default. Now, everyone is very comfortable with the idea that the Fed will not default, that it'll be a political game until the last moment, that some emergency measure may be required to keep the US going for 1, 2, or 3 days, but there won't actually be a default. Think again on this one as well. But before we get to the debt default, I just want to make it very abundantly clear that already the inflation data, the core inflation data, even the headline inflation dropping to 4.9%, it's 0.1%, and this is a survey. So it's almost, all the Federal Reserve will be seeing is, holy crikeys, US inflation is staying way too high, even if rates at these levels But what we will do is we'll stay on pause in the hope that the full effect of previous rate hikes will get this down further. If they do not see that, they are going to hike. They absolutely have to hike interest rates. It's the number one principle and rule of their central bank rule book. That is, you cannot allow inflation to remain stubbornly high. You have to get it down fast. The chairman, Jerome Powell, has said as much himself. In fact, he said exactly that himself. So I want to make it abundantly clear that before we even get to the debt crisis, it's already a horrific nightmare scenario for the US economy and interest rate outlook and banking sector. The economy is slowing rapidly. It's just dropped in one quarter from 2.6 to 1.1%. And the president of the United States is out there constantly saying, we have the strongest economy in the world. They don't. So why is he saying that? Purely for the domestic audience in the hope that they won't notice what's going on around them, okay? But the scary part of that is that it means they're not going to come up with a policy to fight against this economic slowdown, which means the economic slowdown is only likely to gather pace. Okay, so if you're an extreme optimist, you could say, oh, the US economy is stabilizing here, so it's going to be flat at 0 to sort of 1.25% growth this year. Yeah, that's the most optimistic view. So I do think the Fed could be on pause for 2-3 meetings. If core inflation stays high, even at current levels, the Fed will hike again. Okay, so on all of that basis, it's still a very cautionary outlook on US equity prices, bonds, property, and the US dollar. Now, if we add to that an actual US debt default, which by the way, in my own book, I'm seeing as now as high as a 25% chance. That is way scary. So be aware it's more possible than it has ever been before in the history of the United States on this particular event. And this particular event is different in character politically and in terms of economic background and in terms of the Fed response to what was the case previously. But most importantly, it's the difference in the politics on the Hill, where both sides are truly entrenching their view. You could argue that that is a negotiation tactic. Let's be careful here, because there's a lot of people on the Hill who want to fight it to the very end and let the default happen, as it would work against Biden for re-election hopes. As well as the Democrats are Biden himself, incredibly adamant as well. So there is a chance that this entrenched negotiation tactic will actually result in a default this time. And as I said, I give that a 25% probability. That's way too high in anyone's book. Let's hope it doesn't happen. But if it does happen, all of that previous bearish argument I gave you on US assets becomes just amplified. Amplified in the extreme to such a degree that you could see a 10 to 15% decline in the greenback even by the end of this year. This is something to really think about and consider for your investment portfolios, that the outlook for and the repercussions of what happens in the US could well be very much for other Western economies and slightly for Asian and other economies. But certainly if you're holding US debt in any way, or you have borrowings related to bond yields in the US, they could still be going a lot higher, because they would be heavily sold. The bonds themselves would be heavily sold, driving up the yield should there be a US default. The banking crisis would intensify immediately on any collapse in bond prices in the USA. Play defense on equities and on the US situation, and be aware that the US dollar could be particularly vulnerable in coming weeks. Have a great day. Clifford Bennett, Chief Economist, ACY Securities.